Something just happened in the mining market and almost nobody is paying attention. And while the retail crowd is panicking over red charts and selling their positions, a transaction took place in the shadows that screams the exact opposite of a crash. What we're seeing right now hasn't happened since the last commodity supercycle of the early 2000s. We are witnessing a divergence that defies logic. The price on your screen says sell, but the checkbook of the world's largest miner just said buy, to the tune of billions. If this pattern continues, it could mean the smart money, the institutions, the insiders, the whales, knows something retail investors don't. They aren't looking at the price of silver today. They are looking at the availability of silver tomorrow. Stay with me. Because by the end of this video, you won't just understand why this deal happened. You'll understand why the $74 price tag you see today might be the last time we ever see silver this cheap. This changes everything. To understand the gravity of this $4.3 billion bet, we first have to understand the noise that is drowning it out. Right now, the sentiment in the silver market is terrible. We just saw a massive correction. We touched highs of nearly $120 in January, and now, here we are, grinding around the mid-70s. It's painful, I get it. When you see your portfolio drop by 30% in a few weeks, the natural instinct is to flee. The mainstream financial media is feeding you a narrative of deflation, high interest rates, and a strong dollar. They tell you that industrial demand is slowing down because the global economy is cooling. But let's look at history. Last time major institutions made capital commitments this large, it signaled a definitive bottom in the market cycle. Think back to the bottoms of 2008 or 2015. In every single instance, the pattern was the same. Retail investors, the dumb money, sold the dip because they were reacting to yesterday's price action. Meanwhile, institutions were buying the asset. Why? Because institutions don't trade price. They trade value. And more importantly, they trade time. When you sell silver at $74 because you're scared it will go to $60, you are reacting to short-term fear. When BHP and Wheaton Precious Metals sign a deal that lasts for 30 years, they aren't worried about next week's Federal Reserve meeting. They aren't worried about a temporary holiday liquidity squeeze in China. They are looking at a fundamental reality that the paper market is ignoring. The paper market is focused on the US dollar index being at 97.12. It's focused on high-frequency trading algorithms, manipulating thin holiday volume. But the physical market, the market where actual metal moves from a mine to a factory, that market is screaming shortage. This disconnect between the paper price, which is dropping, and the physical demand, which is skyrocketing, creates an arbitrage opportunity. And that is exactly what the hidden force in our story has just exploited. But here's what most people don't realize. The hidden force isn't just a random billionaire buying some coins. It is the landmark deal between BHP, the world's largest miner, and Wheaton Precious Metals, the world's premier streaming company. For those who don't know, let's clarify what a streaming deal actually is. This is crucial. Wheaton Precious Metals is not a miner. They don't own dump trucks. They don't hire geologists to dig holes. They are essentially a specialized bank. They provide upfront capital, cold, hard cash, to miners in exchange for the right to purchase a percentage of future metal production at a fixed, low price. This week, Wheaton agreed to pay BHP $4.3 billion in upfront cash. In exchange, Wheaton gets the rights to the silver stream from one of BHP's massive copper expansions. This isn't day trading. This is a strategic takeover of future supply. Why would BHP do this? BHP is primarily a copper and iron ore miner. Silver is a byproduct to them. By selling the future silver to Wheaton, they get billions in cash today to fund their copper expansion without issuing debt or diluting their shareholders. It's a win for them. But ask yourself, why would Wheaton pay $4.3 billion now? Why not wait? If silver is crashing, if the charts look so bad, why drop the GDP of a small country onto the table right now? Because Wheaton knows that the cost of finding new silver is skyrocketing. They know that permitting a new mine takes 10 to 15 years. They aren't buying silver at today's spot price of $74. They are securing silver for the next 20 years at a production cost that is significantly lower. They are locking in supply because they know that by 2030, you won't be able to find this much silver anywhere, at any price. Let's get into the math, because this is where the bullish case becomes undeniable. Here are the facts that the mainstream news is glazing over. Fact number one, the sheer size of the deal. $4.3 billion is one of the largest streaming deals in history. You do not deploy that kind of capital into a falling knife unless your internal analysts, who have access to data we can only dream of, are convinced that the floor is in. Fact number two, the timing. Silver is trading in the mid-70s. We are in a correction. Usually, deal-making freezes during corrections because buyers want to wait for the bottom. Wheaton didn't wait. They struck while the market was fearful. This tells us they believe $70, $75 is a value zone, not a cliff. Fact number 3, the byproduct reality. Most of the world's silver comes from lead, zinc, and copper mines. BHP is expanding copper production because the world needs copper for electrification and AI data centers. But here's the kicker. The silver grade in these major mines is degrading. To get the same amount of silver today, you have to dig up twice as much rock as you did 15 years ago. That costs energy, that costs diesel, that costs labor. The floor price of silver is rising because the cost of extraction is rising. Wheaton knows that $74 is actually cheap when you factor in inflation and ore degradation. Let's look at one shocking number, the global silver deficit. The Silver Institute projects a deficit of 67 million ounces for 2026. This is the 6th consecutive year where demand exceeds supply. We have burned through the above-ground stockpiles. The London vaults are draining. The Shanghai inventories are at 10-year lows. Wheaton's $4.3 billion isn't just a bet on price, it's a bet on scarcity. They're buying the last available lifeboats on the Titanic before the crowd realizes the ship is sinking. And this is where things get serious. Institutional players like Wheaton and BHP don't drop $4 billion on a whim. They don't do it for a 10% gain. They are positioning themselves for a paradigm shift in the global economy. We are moving into an era where silver is no longer just a monetary metal or jewelry. It is a strategic technology metal. You cannot have a green energy transition without silver. You cannot have the AI revolution without silver contacts in high-end electronics. And the escalation here is that the industrial demand is becoming inelastic. That means Apple, Samsung, and Tesla must buy silver regardless of the price. If silver goes to $100, they buy. If it goes to $200, they buy. They need it for their products to work. By locking up the supply from BHP, one of the few stable, large-scale sources of new silver, Wheaton is effectively cornering a portion of the future market. When the shortage hits the headlines, when Samsung and Tesla come looking for silver, Wheaton holds the cards. Meanwhile, you're worried about the price dropping $2 today? You're looking at the waves while they are watching the tide. The liquidity squeeze we are seeing right now, the holiday squeeze with China closed, is a temporary blip. It's a sale. And the biggest wallets in the world are shopping. So, where do we go from here? We are at a fork in the road. Based on this institutional activity, I see 2 distinct paths for the next 12 to 24 months. Scenario 1, if institutional accumulation continues like this, we will see a solid floor form around the $70, $74 level. The BHP deal is likely just the first domino. Other players, royalty companies, sovereign wealth funds, maybe even central banks, will step in to secure physical assets. In this scenario, once the liquidity returns to the market and the Federal Reserve cuts rates later this year, as the CPI data suggests they will, the dollar weakens and silver launches into the next leg of the bull run, easily reclaiming $100 and targeting $150. The smart money rides this wave up, having bought at the bottom. Scenario 2, we must be realistic. If industrial demand for copper and mining byproducts falters, if we enter a severe global recession that crushes manufacturing, then this new supply might take longer to come online, or demand might temporarily dip. In this case, silver might grind sideways. We might even see a retest of the high 60s. But, and this is critical, even in a recession, the production of silver will fall because miners will shut down. This only makes the future supply crunch worse. The $4.3 billion deal proves that long-term players aren't afraid of a recession, they're afraid of running out of metal. Which path seems more likely? Look at the debt. Look at the money printing. Look at the green energy mandates. The demand isn't going away. The supply is. The math favors scenario 1. If you're involved in long-term investing, this is not something you can ignore. The market is giving you a signal. It's loud and it's expensive. $4.3 billion loud. It is easy to buy when everything is green and everyone is celebrating. It is incredibly hard to buy, or even just to hold on, when the charts are red and the pundits are screaming crash. But history rewards those who follow the money, not the mood. BHP and Wheaton have placed their bets. They are betting on a future where silver is scarce, essential, and much more expensive than it is today. The only question left is, are you betting with them or against them? If you want to stay ahead of the crowd and get real updates on these institutional moves, not just the daily noise, make sure you subscribe and hit that notification bell. I'll be tracking this deal and the inventory levels closely in the coming weeks. Thanks for watching. Keep stacking, and I'll see you in the next one.